Hello, everyone. This is Zak Gardezy, founder of Wealthstone Private Wealth Management, certified financial planner, and private wealth advisor. Welcome back to Money Minutes, my weekly market update series, where I share the latest market headlines and provide my outlook on what's ahead. So, in this week's episode, we'll cover the latest market movements, particularly the S&P 500's rough start to September, and I'll explore why this month is historically a weak month for markets. So, let's dive right in. So in August, we saw extreme volatility with the market experiencing a sharp correction, which is defined as a drop of 10% or more in certain stocks, sectors, or even the entire market. Now, after that correction, the market rebounded almost fully, showing just how turbulent things have been. Now, September has really picked up right where August left off, with the continued volatility driven by several key factors. Now, remember, volatility stems from uncertainty, and right now we have plenty of that. So, for example, in corporate earnings and AI, some stellar earnings reports, like Nvidia's, but they didn't meet the market's high expectations, which fuels concerns in the AI space. Moving on to political uncertainty, the upcoming US presidential election, which is now leaning towards Vice President Harris, has the market pricing in some potential policy changes, including higher taxes and a different agenda than former President Trump's. Now, discussing geopolitical tensions, in Europe, Ukraine is making advances, even striking near Moscow, while Russia is reportedly considering making changes to its nuclear defense policy. And meanwhile, in the Middle East, tensions between Israel, Iran, and Hezbollah have escalated, though they've calmed since their peak in August. However, the risk of a regional conflict, which could affect global oil prices, remains high. And shifting back towards the United States, economic data shows a clear slowdown, which is exactly what the Federal Reserve intended. Now, the labor market is cooling off, and all eyes are on the Fed's upcoming meeting, which takes place on September 17th and 18th. And according to the CME Fed Watch tool, there's a 55% chance that we get a 25 basis points rate cut and a 45% chance of a 50 basis points cut. So, while a rate cut could boost the market by signaling a shift from restrictive to more accommodative monetary policy, it's not necessarily good news for the economy. The Fed might cut rates not because inflation is under control, but to avoid a recession, much like the European Central Bank did earlier this year. Traders are also pricing in steep rate cuts for November and December. And while the initial rate cuts may be welcomed by the market, volatility around Fed decisions throughout the rest of the year will likely increase as traders balance their expectations for more cuts with continuously negative economic data. And really, the Fed's challenge reminds me a lot of SpaceX's Falcon 9 rocket, the way it lands. So it tries, for example, with SpaceX Falcon 9 rocket, it's landing basically a rocket, which is coming down on a floating piece of rock in the middle of space, and the rocket's landing on a moving launch pad in the middle of the ocean. And so inflation, it's down, but the labor market is weaker. Unemployment is still historically low. The Fed could technically achieve a soft landing, but that window is really starting to narrow. And you may be wondering, what should I do during times like these? Here's what I'm discussing with clients, family, and friends. And given the uncertainty, it's really crucial to start to review your portfolio, your investment objectives, and your overall financial plan. For example, if you're holding significant cash, I wouldn't recommend a large lump sum investment into the market right now. Instead, consider buying into key names when corrections occur, as we saw in early August, or using dollar cost averaging to enter the market more gradually. I expect increased volatility between now and the election, which means we can pick our spots. And for those already invested, avoid excessive exposure to cyclical or speculative assets. And any of the factors we've discussed could really cause the market further disruptions. And you really don't want to be stuck holding speculative stocks that may not survive a sharp downturn. So remember, the month of September is historically a weaker month for the markets. And this is because, as the summer comes to an end, trading activity typically picks up around this time, which brings more volatility to the markets. And so to wrap things up, Wealthstone clients, as always, you'll receive my monthly portfolio reports and my market commentary. But for everyone else, If you're looking for a second opinion, or you have questions about investing or financial planning, please feel free to reach out. And again, thank you so much for everyone for tuning in to this week's episode of Money Minutes. I'll see you all again next week.